a guest speaker today to talk about with Elevate Commercial Investment Group, talk about alternative investments. Right, we're going to go ahead and first give a little bit presentation about what we have going on with Quest at the moment. And stay tuned. Again, this will also be on Facebook Live. We also have Logan on there in the chat box who will be assisting with any live questions. So let me go ahead and start with sharing my screen real quickly. One moment here. All right, guys, and George, if you don't mind, just give me a thumbs up if you see the right screen, just so I can know. Cool.
Oh, good.
Awesome. So, guys, welcome to our self-directed IRA weekly webinar. I'm Juan Deshawn with Quest Trust Company, one of the IRA specialists here. So if you've called Quest Trust Company, you may have spoken to me before. If you're new to Quest, then who are we, right? We're a large self-directed IRA custodian here in Texas. We have 20,000 or over 20,000 active investor clients across the country. We have 2.1 billion in assets under management, right? 100 employees with 34 certified IRA service professionals, which just means that we know a lot about IRA accounts. We have $400 million in undirected cash, meaning a lot of our clients have cash sitting in their retirement accounts waiting to make that next deal. And kind of the reason why we host these events is not only to provide education, but also to provide opportunities. But a little bit of disclaimer, of course, I'm not going to be giving tax, legal, investment advice. Quest Trust Company doesn't broker any deals. Everything here is for your education only. And please double check with your financial advisors, your attorneys, CPAs before you make any investment, right? What else do we have going on at Quest? We offer free endless education. This is a few snippets of what we have going on. If you go to questtrustcompany.com, you'll see our weekly live SDRA classes, our SDRA Saturdays, our virtual networking happy hour, and our SDRA socials. Our happy hours are great events if you are looking for deals, looking to pitch investments. We had one actually just last night. Our SDRA socials are ones that are happening in offices, Houston, Austin, and Dallas for in-person networking. Saturday events are just classes that allow individuals who can't make it during the week, but to join online on the weekends. And then, of course, the winner joining today is that weekly live STRA Saturday class. What we have going on this week, promotional-wise, it is National Retirement Securities Week. So what we have going on for you guys is $50 off your application fee, as well as a free ticket to QuestCon Live, right? That promotional code is Retirement Ready. And if you have any information or interest in our QuestCon Live event, scan that QR code. It'll give you everything you need. The event is December 3rd to the 4th. It is a completely online event. So you can watch it from the comfort of your home. You can watch the replay if you can't attend the entire event, but we will be going over a lot of things. The main category, the main focus will be forecasting the real estate market for the 2022 year and see how we can, get ahead of the ball game there. And then lastly, my information or my team's information is IRA Specialist at questtrust.com. If you guys have any questions after watching this webinar, please reach out to us at IRA Specialist at questtrust.com. Check us out on Facebook, check us out on LinkedIn, check us out on YouTube channels and all that stuff right there. But again, without further ado, the real meat of this presentation is really going to be not me, but George here. So he's with Elevate Commercial Investment Group. He's going to talk about alternative investment opportunities. A lot of our clients using self-directed IRAs, they look for those alternative investments. And in my opinion, the best ones are the ones that are fairly passive for your IRA accounts, right? Put your money to work. You don't necessarily have to worry about it. Someone else is going to put that money to work for you, and you start taking that return. So George, thank you for joining today. And tell us a little about what you got going on for yourself.
Yeah, thank you, Juan. So I'm a owner operator of multifamily real estate. Been investing in real estate for about 16 years now. Full time, graduated with an electrical engineering degree, did that for about a year. And I think before I even graduated, I knew I didn't want to be an engineer, but started looking into real estate and really found a passion for it and being able to especially take some of these ugly properties. Back when I started, it was mainly single family, and then transforming them into something where a family can move in and really enjoy it. Throughout the years, I kind of took that to where now we mainly focus on 100 plus multifamily units. And we've got right around 5,000 units right now under management, about 350 million assets under management, and growing. You know, it's been a really hot market, especially this year. And before I got into, and I'm going to share my screen here shortly, but just to tell you where I'm coming from as far as the passive investments. So I had been doing mainly single family and maybe some small multifamily properties, and a lot of it was fix and flips. So I was getting taxed pretty hard on most of the stuff I was doing till I got familiar with large multifamily properties. And before I actually acquired one, I started investing myself because I wanted to see how this worked. You know, a syndication, I had never done a syndication before. And so I think that was 2018. Invested passively in some deals that I did not own. You know, somebody else was the deal sponsor and running the deal. I guess technically I did have an ownership since I was investing that deal, but I wasn't running the operation. And then I got my K1s with the depreciation and started getting my returns, and it just blew my mind because I had not, you know, I had invested some money in stocks, and I didn't have an IRA, but you know, I hadn't seen anything like that before. So I really got hooked, and you know, every year I'm investing, not just acquiring these properties, but investing a good chunk of my income into them as well. So with that, I'm going to go ahead and share my screen and tell you guys a little bit more on how you can do that and what the benefits are. Just let me know, Juan, if you can see my screen.
Can, yes, sir. And I'm going to go ahead and stop my video, but go ahead and take it away. And I'll pop in if we have any questions, things like that. And then we'll hash it out there at the end. So appreciate it.
Okay, sounds good. And I'll try to, I don't see this being more than an hour. Okay, so like we talked, I'm going to go through the benefits of alternative investments. So, you know, when I think of alternative investments, to me, that's something other than your typical retirement plans or stocks. You know, everything that's kind of what we've led to believe is where you should be putting your funds, and then that's the way to retire. Okay, I guess this is the first time I do this slide, so I might get surprised on some of the slides. But this is just a little bit more about me, I guess. I'm the CEO of J&T Construction and also Elevate Commercial Investment Group. So we do our in-house construction, and we also do some third party for other investors. And then Elevate is where we purchase the properties. And I kind of already gave you some of the stats. And then that's my family there. Got 3 little girls, and that is definitely my why. As far as Elevate, not much more to say there. You know, we're definitely growing and looking to be at probably 10,000 units next year. So speaking of why, you know, I think that's kind of where we need to start when we think of our investments and what we're trying to accomplish. You know, when you want to know what you're trying to accomplish with your funds, and that should determine where you're going to invest and what type of, when it comes to real estate, what type of deals you're going to invest in. Some are going to be more cash flow heavy. So if you're wise to get cash flow, obviously that's what you want to be looking at. Some may not have any cash flow, but you're going to be able to get a larger return at the end of the day. So I say first start with the why, try to figure out what you're trying to do. I know when I went down this path, my why was to purely just create wealth. I don't need the cash flow necessarily. It is nice to be getting, monthly or quarterly checks, but I'm somewhat a little more aggressive on some of my investments because I'm looking to really build up the wealth, um, the generational type wealth. So answer that question first, and then make sure it's aligned with your goals, whatever you're investing in, that it's going to get you the outcome you want. So, number one, start now. Don't keep putting it off. We tend to do that with a lot of things, right? I think this is a priority. It's not something that's going to affect us this instant. So I think that's why we sometimes tend to put this off. But if you invest correctly now, that can dramatically change what your life looks like 5 years from now, 10 years from now, 20, etc. So we already talked about, knowing what you're looking for. Definitely take advantage of the power of compounding. I don't think I've got a chart in here, but if it's amazing what money can do once it begins to compound. Definitely pay attention to some of the fees. Investing with let's say, stockbroker, you're thinking you're getting a certain amount of return, but then sometimes when you take the fees out and then your taxes, the return is nowhere near what you actually thought it was. And then always diversify, even within certain markets. I mainly do multifamily real estate, but even within multifamily, I'm very diverse. So do your homework. Obviously, you may not need to know, for example, with multifamily real estate, you may not need to know the ins and outs of running the day-to-day of a apartment, but you need to know enough so that you make sure that you're getting into good deals and how they're performing, etc. So make sure to get the knowledge on, if you got a 401k, know enough to where when you're going to get with fees and what you can do with that, and obviously look into self-directed IRAs. Hopefully you've got an account with Quest already. I know by far everybody I've referred to them has nothing but good things to say. And the important part of self-directed is you want to be able to direct where those funds are going to be invested. Okay, so now we get to why I think real estate is the smartest way to go. There's a lot of benefits to investing in real estate, and specifically in multifamily. So like we talked about, it's going to produce some cash flow. So depending on the deal you invest in, you're going to get either monthly or quarterly distributions. If it's what we call a heavy value add deal, which means when we're buying it, it may not be cash flowing very well, and we're going to have to improve it. You may not start getting that cash flow right away. Usually, I know if we're doing a heavy value add, we usually give it about a 6 month before we send out a distribution. And then on the ones that are cash flowing from day one, we don't waste time. We'll send you a distribution first month in. On top of that, it's going to give you equity in the deal. Obviously, it uses leverage, meaning you can get into a 100-unit apartment with, let's say, $100,000, which if you didn't have that leverage wasn't there, or if it wasn't a syndication, there's no way you'd be able to own a piece of a 100-unit apartment with $100,000. It appreciates. It can be forced appreciation. So if we're adding value to the apartment, for those of you that don't know, an apartment is not valued like a single family home. It's not just based off of comps and what's selling in the area. It's ran as a business. So you're essentially buying a business, and if you're able to increase the net operating income of that property, then you increase the value. So there's ways to force that appreciation versus just with a single family home, you kind of just need to sit back and wait, and hope that the market appreciates the value. And then there's amazing tax benefits. I'm not going to go too deep into that. I suggest you get with a CPA and kind of see what you can take advantage of. I will say that there is a lot that you can take advantage of with multifamily real estate as far as tax benefits, but there are certain criteria that you need to meet to get the full advantage of it. So as far as the increased cash flow, especially right now, rents are climbing dramatically. Single family homes are becoming very hard to afford with the prices and how they've skyrocketed in the last year or so. So you've got more families and individuals going to rent instead of purchase something, which has given us operators, the chance to increase some of the rents, and doing that then in turn gives us more cash flow in the properties. So the acquisition costs, when you look at it per unit basis, it definitely seems very affordable compared to maybe just buying a single family home. Foreclosures. So back in 2008, when we had the crash, obviously most of you probably know we had a lot of foreclosures in the single families. When you compared that to apartments, it was very, very minimal. So multifamily historically is one of the best performing real estate assets in any real estate market downturn. And then because of that, we are able to get really, really good terms on debt. And it's mainly because, like I said before, you're essentially buying a business, not really not just real estate. You're buying a business as well. They're a lot easier to manage because we're able to hire on-site staff, versus if we just had a few single family homes. Whoever owns those few single family homes is going to be doing a lot of the work themselves. And if they do hire somebody to do it, then it's not really producing enough income to pay that individual and leave a good amount of cash flow. So there's also, you get the benefits of scale. As far as expenses, we're able to drop those expenses because we have so many units. Yeah, so a lot of benefits there, being able to buy several units under one roof. And like I mentioned, the tax breaks. We do something called a cost seg study, where an engineer comes out and essentially the depreciation on the property and the building, we're able to capture a lot of that on the first year. So for instance, I know we have an offering right now that we're raising equity on, and we are getting, for every $100,000 invested in the deal, there will be a K1 for negative 138,000. So 138% of the money invested is going to come back in the first year on their K1 as a loss of 138,000. So a lot of benefits there. That specific one is only around till next year, and then it's going to start to taper off. So definitely look into taking advantage of that. The high appreciation rate, especially in the last 3 years, has definitely been crazy with depreciation on the value of multifamily. I think between COVID and just, I guess, probably from a trickle effect from also looking back in 2008, there's been a lot of attention towards multifamily, which has caused this appreciation and compression of cap rates, which is what drives the value of multifamily. So I've kind of talked about this already, but it's considered a less risk because historically, like I mentioned, it's performed really well during recessions, and I guess we can now say pandemics as well, because multifamily performed actually really, really well through COVID. The first few months was, there was a lot of question marks and a lot of unknowns going on, but as we moved through the pandemic, multifamily overall ended up performing really well. It helps you build a portfolio quicker versus just buying a single family home, or let's say a fourplex, or smaller multifamily. You're able to build that quicker. So I know I've mentioned the word syndication and kind of wanted to go through what that means. So big picture, it means when we go to acquire these properties, like I mentioned, the debt, we get really good terms. Right now, it's very easy to get maybe 80% of the cost, meaning the purchase price, any repairs we're going to be doing, any closing costs, the full capital stack needed to close on that apartment. We'll get about 80, maybe even 85% from debt. Then that difference, whether it's that 20% or 15%, we need to bring that to the closing table. And what we do is we syndicate it. We get several investors to come together, and they become passive investors in the deal. And then you have your main general partners that will be running the day-to-day. So that's essentially what a syndication is. It's governed by the SEC. There's certain forms we need to follow, certain reporting that we need to do to our investors. So yeah, this is kind of showing what I just said. Let's say we needed 1.5 to close on this apartment. Then we would get several investors with 100K, 50K, whatever it is, and put that together and then close on the apartment. Some syndications require the investor to be accredited. Some require them just to be sophisticated. The difference there is an accredited investor needs to make at least 200,000 or 300,000 if married in the previous 2 years. And if they do that, you consider an accredited investor. Or if they have a net worth in excess of $1 million, that's excluding your homestead. So if you check one of those two boxes, then you're considered an accredited investor. To be a sophisticated investor, essentially, you just need to acknowledge that you understand what you're getting into, and you understand the risk and whatnot. The difference there is mainly if someone that's doing a syndication wants to market that to the masses, then their investors need to all be accredited. If they just want to send it out to their friends, their family, I don't even want to say acquaintance, they need to really know that individual. Then they can just be sophisticated. They don't necessarily need to be accredited. There's a little more to that. There's only a certain amount of sophisticated investors that can be put into a syndication, but that's a quick explanation on that. There are some other, so they changed the criteria for accredited investors, and there are some other ways to meet that criteria. I don't think I have it here in this slide, but if you look it up, you can find it. It's just things like if you work for somebody that is doing the syndication, is going to be sponsoring the deal, then you're able to also invest in that deal, and a couple other ones that they ended up adding recently. Okay, so then this talks about what if you're not an accredited investor. So then you're going to be looking for somebody that's doing what they call a 506B, and that's where they can take sophisticated investors. Oh, and here, I did have this here. So yeah, max of 35 sophisticated investors in each syndication. But yeah. Okay, and then a quick explanation on what's a GP, what's an LP. So the general partners, or what they call the sponsors, are the ones that are putting the deal together. They found the property, they've analyzed it, they're going to apply for the debt, put their name on the loan, and then once the property's closed on, they're going to run it. They're going to make sure the business plan is getting executed. Those are the GPs. They're also called active investors. And then you have the passive investors, or the limited partners. So these are the ones that are just going to invest in the deal, and they're going to let the sponsors run it for them. And in turn for that, they're going to receive the distributions and whatever percentage for that deal in the equity once it sells or refinances. But they're not really making any major decisions on that property and how it performs. So as far as step-by-step, a syndicated investment, the first thing is the investor is going to make, or the deal sponsors are going to make an announcement that their offering's open. Usually it's going to be an email, unless they're doing a 506C, which is the accredited investors only. You may see some things on social media, or you've got ads running, radio. They can pretty much market any which way they want. Then the next thing is, let's say you see one of these, you get one of these emails, or you see one of the ads. Usually it's going to drive you to what they call a summary deck or offering memorandum, and that's going to explain to you about the deal and show you some of the numbers and what the plan is on how to increase the value of the property. And also most likely will show you what projected returns the investor should see for investing in the deal. The next step will most likely be committing, doing a soft commit or soft reserve, which is saying, let's say you have $200,000 that you want to invest in it. You've reviewed the documents and you're interested. Then you submit that reserve, and then either directly after doing that, or sometimes the sponsors will wait a few weeks and then they'll submit the documents. Your PPM is what they call it, private placement memorandum, and that will go into a little more detail and explain. It's essentially explaining all the risks. You know that nothing is guaranteed in real estate and in investing in these types of deals. And then it goes into a little more about the deal sponsors and whatnot. But yeah, sometimes the investors will also host a webinar, and then drive everybody to put their commitments after that. And then, yeah, if you fill out that PPM, then the sponsor will confirm that you're in the deal, and then ask you to wire your funds by whatever date. And then you kind of just sit back, wait till the deal closes, and hopefully begin to get the distributions as they listed. Sponsor confirms your funds have been okay. So yeah, so the sponsor will notify you once it closes. I know we also do welcome package on our deals, and we'll send our investors. You know, we like to. So I mentioned when I invested passively in some other deals before I actually started acquiring some of them, and a lot of that was a great experience. One, to see how the returns look and how that's handled, but also to see how other sponsors treat their investors and what the expectations are. So I know I wanted to do it a little different, and I wanted to get our investors very involved. So we send this welcome package, and it's got a physical note binder that has all the information about the property. It's got space for you to put your K1s every year, and just make it feel more physical versus just on paper. And then we're constantly updating our investors at least once a month. You may see others that only do it quarterly, but you know, we like to show our investors what their money is being used for. We do videos, pictures, especially showing the renovations. So yeah, this talks about the monthly, and then you'll get a K1 every year. And that was what I was talking about, where you'll have some of that depreciation on there. Yeah, and then I'm not going to go through all this, but just I think I kind of explained a little bit about the PPM already, but you know, this is required by the SEC for us to put this paperwork together. We have an attorney, SEC attorney, that puts it all together, and it, like it says here, explains all the side effects, and also explains the organization of the entity and how it's all structured. So yeah, it's very important to read through the PPM and really understand what you're signing. The size of the offering. Okay, yeah, I'm not gonna go too much, and I'll give you guys a chance to get these slides. I'll give you my email on the last slide, and you can definitely send me an email, and I'll shoot these over to you if you want to look at it in more detail. But yeah, it should have a bio in there as well from the deal sponsor, and kind of explain their track record. The terms for sure would be listed in there, as far as any fees that are being paid, what the splits are. So, you know, there's a lot of different ways to structure a syndication, and actually, I think I go into that into a couple slides down. So let me Yeah, so here's a very standard way to structure this, where 30% of the equity would go to the deal sponsors, the GPs, 70% of the equity goes to the limited partners. So that means, anything being produced, as far as cash flow, or if there's a cash out on the refi or the property sold, that would be split 30-70. On the sale and on the refi, first things first is we return the investor's capital. Once we've returned their initial capital, then it gets split 70-30 or whatever that split is. You'll find a preferred return on a lot of syndications as well, which means that the investors will get, let's say it's a 6% preferred return, versus those funds being split 30-70. The investor is going to get that 6% preferred return first, and then it'll be split 30-70. And then there could be what they call hurdles, meaning if, in a sense, a hurdle is almost a way to motivate the sponsors to really take it to almost the next level and outperform. So there'll be some type of metric set where if the sponsors are able to get the investors, usually it's an IRR return. So let's say they're able to get them 16% IRR. Anything after that 16% IRR then is split in a different fashion, like let's say a 40-60. That's a pretty bad example. This is a single family example, but I guess this is kind of just showing you where cash flow comes from. Obviously, income minus expenses, and then that's going to create the cash flow for the property. And then, sorry, this is a little blurry, but this is an example of what a syndication may look like. So, here you got a purchase price of $20 million. They're going to put $2 million into the property to fix it up. Seems like there's a 250 unit. Then equity multiple 2.1. So that means if you're putting in 100,000, you're projected to get 110,000. Your 100,000 back, and then an additional 110,000. Internal rate of return at 16%, and then an average annual return. So on the cash flow and the distributions, an average of 8.3%. And then looks like this is a 5-year term. So they're projecting to sell it in year 5. This is showing you what your annual percent return is. So your cash flow here, 5.3 first year. So typically it's going to be a little bit less year 1 as the deal sponsors begin to implement the business plan and get the property producing more income. And then you can see how it increases every year. This one says 70%, that's including the proceeds of the sale. That's why it's so high there. And yeah, so year 5, you would get your 100,000 back and another 110,000, well, minus what you got these years, right? And that's it, on to another syndication, hopefully. I know that's usually the way I'm doing it is when we're exiting a deal, I'm then taking those funds and either doing, well, most likely putting into another deal to continue to get more depreciation on the next one and not get taxed as much on the income made there. Okay, looks like that's the last slide. And this is my email. So if you guys want to email me and ask me, I can send you the slides. And here's a little bit more information if you want to see information about our company. You can find me or my company on social media, pretty much all the platforms, except maybe TikTok. But yeah.
So you'd be surprised. I see a lot of real estate investors now
Yeah, I'm
using
actually on
TikTok.
there and I've done a
Oh,
couple
are you?
videos, but yeah,
Yeah,
not
I
very
see people
active.
like doing little videos, but great presentation. I mean, it really goes over exactly what I see when I see a client invest into syndications. That's kind of the terminology we use, but at the end of the day, I see a lot of this stuff that you went over. For the people kind of joining on, I have a question. So you, as someone who raises capital for these syndications, just out of curiosity, do you use private money? And if you, off the top of your head, what kind of percentage usually is that?
When you say private money, like
I mean,
private
IRAs,
individuals.
yeah, IRA money. Sorry.
Oh man, on every deal we have, um, an average maybe 20% of the investments or
Yeah.
so are from an IRA.
Yeah, that's on average what we see. And do you guys have like specific requirements, like in the industry, that are typically requirements that you guys look for an IRA to be involved? Is there minimums, things like that, or do you know there's some like what's the lowest minimum you've seen out there?
I mean, there's been some pretty low minimums, but on average, you're looking at it maybe 50,000 to $100,000 minimum.
Hmm.
We don't really have any other criteria. Like it's not more work for us to take it on.
Right.
A lot of times we're even able to take somebody on that doesn't even have a self-directed yet, and then
Right.
we send them over to you guys. You guys set it all up,
Right.
and they go ahead and invest.
Yeah, no, absolutely. The reason why I ask this question is because I want to definitely make it known that this is a huge asset class for IRA accounts. It's because of the passive nature of it, right? So a lot of our clients are doing these kinds of things, and I think people just need to reach out and kind of find these opportunities. You mentioned it kind of in the beginning that these syndicators host like webinars that go over the offerings and stuff like that. Like, where do you usually find those? Are those just simply you have to be invited to them? Are they marketed online?
Usually yeah, I guess I was going to say that you'd have to be invited to them, but I mean now a lot of the companies are doing 506Cs. I know most of ours are 506Cs, meaning that we can market them online. Right now we have two offerings. They're both um, all over social media, and um, yeah, usually if you find one of those. So as far as how to find more syndicators, um, I think you can just search Google at this point. It used to be harder.
Right.
um, 5 years ago, 6 years ago, it was more difficult. But right now, search social media, search Google, multifamily real estate investor or syndication, and you
Right.
should find quite a bit. Do your research. Try to get referrals and whatnot. Not every syndicator is the same.
Right. Yeah. So yeah, exactly. Do your due diligence, right?
Yes.
Absolutely,
Yes.
definitely.
Absolutely.
Yeah. Look at the person's track record, et cetera. Well, if there aren't any questions kind of in the chat box in the Q&A, you guys have his email address there, his website right there as well. Before we let you go, George, is there any last thing that you want to say? Anything you want to leave, a little piece of wisdom you want someone to take out of this presentation if they took out one thing?
Yeah. I mean, don't don't leave your retirement plans or your investments to someone else. Like, um, take control of it and make the most of it. I feel like we've, as a culture, like things are changing a little, but before it was kind of like, okay, I've got my retirement plan, or the company that you work for has got this set up, so um, that's how I'm going to retire. I'm just going to keep putting money in there, and it's it's not that simple. Things are getting, inflation's for real. Things are getting more and more expensive. You've got to really be able to build that wealth up.
Absolutely. Absolutely. Yeah, no, you're right. I mean, everyone, you got to get out of the mindset of, just 401k, that's gonna be retirement. I mean, it takes a lot more money now for an individual to retirement and keep their current lifestyle than it did in the past, right? I think I've done the research, and everywhere, give or take, I mean, in order to retire comfortably, you have to have saved up in a retirement account like above $2 million to have a pretty comfortable retirement. Meaning like a comfortable retirement, I mean like where you don't have to sacrifice anything. You continuously live and as you have been. So, but I appreciate your time. Thank you for joining. And hey, guys, again, if you have any questions, that's his information. So please be sure to reach out to IRA Specialist at questrust.com. And we can also send you the information if you weren't able to grab it. Right. So that's pretty much all we got for you guys today. Please join us on the next upcoming webinar. Thanks, George.
Thank you. Appreciate it.